Let us begin with question number 1. Let us read this question. NAV as on 1/4/2010 is given as 35.44. NAV as on 1/4/2011 is given as 37.26. The company made a distribution of rupees 1.2 on account of dividend and rupees 1.6 on account of gains. Determine the rate of return for the investor. Now friends, this is a straight simple question and you just have to put these values in the formula that we have learnt to determine the rate of return. And if you can see, the holding period is exactly 1 year, so you calculate the rate of return and that will be directly the annualized return itself. So let us see how to present the solution. You put the formula for rate of return. We have already discussed the logic behind this formula. You will write the formula, you will mention the details of all these variables, and you can see one thing, NAV1 and NAV0 are NAVs at end and beginning of the year, because the holding period over here itself is 1 year. Now you just substitute all these values in this formula and see what you get is rate of return as 13.04%, and this rate of return is a per annum rate of return anyway. So do one thing, write up this whole thing and that will be end of the solution. Alright friends, you would have finished writing this whole thing. Let us move ahead and take up the next question, that is question number 2. Let us read this question. Mr. A purchased 2000 units of a mutual fund on 1/6/2010. NAV as on that date was rupees 41.34. By 31/3/2011, he received a dividend distribution of rupees 7 per unit, and NAV on 31/3/2011 was 46.35. Determine the annual rate of return. Now, if you analyze this question, this is the date on which the investor has made investment, that was 1st June 2010, and the holding period is up to 31/3/2011. So it is a clear evidence that the holding period is not 1 year, it is little less than 1 year. So if you can count from June 2010 to March 31, 2011, it will be exactly 10 months of holding period, and whatever rate of return you compute initially will be the holding period return for 10 months, and then we can convert that into annualized value, that will be the annual rate of return. So let us see how to present the solution. This time when you write the formula, that formula will be for HPR, that is holding period return. The formula is structured the same way, only the point you have to consider is NAV1 and NAV0 should not be written as beginning and end of the year, it should be at beginning and end of the period, and here the period is 10 months. This time if you see, I1 and G1 is combined and given to you as rupees 7. So we don't have separate information about how much was distribution on account of dividend and how much was distribution on account of gain. So we have clubbed the both, and now finally when you compute the HPR, what you get is 29.05%. Now this rate of return is not for the entire year, it is for the holding period of 10 months. In the next working we are going to annualize this, but before we go ahead, please write up what you find on screen. Alright friends, you would have finished writing this whole thing. Let us move ahead and now compute the annualized rate of return. The annualized rate of return will be HPR, that is holding period return, into 12 by number of months as holding period. As I have mentioned, the holding period was 10 months in this case, so 12 divided by 10. In any case, if the holding period is given in days, in the numerator in that case, instead of 12, you would take 365 or 360 depending upon how many days you consider in a year. Finally, in this case, the annualized return is 34.86%. So do one thing, write up this whole thing, and that will be end of the solution. Alright friends, you would have finished writing this as well. Let us move ahead and take up the next question, that is question number 3. Let us read this question. Mr. X purchased 10,000 units of a mutual fund on 1/4/2010 at a cost of rupees 25 per unit, which was NAV per unit on that date. The mutual fund company announced some additional bonus units during the year. Mr. X determined that his annual return as on 31/3/2011 as 20%. You are required to determine NAV on 31/3/2011 and the number of bonus units allotted if the value of such bonus unit was 20,000. Also specify the NAV if rupees 20,000 was not distributed as bonus but as dividends. So friends, in this question you find an additional information about bonus units, and let us see the impact of issuing these bonus units by the mutual fund company and how to determine NAV. And also one thing, how to determine NAV if that 20,000 as value of bonus was not obtained by the investor as bonus but was obtained as a cash dividend. How would it impact the NAV? Let us see how to present the solution. Now in the solution, you would first write the formula and you define the variables. So we know one thing, NAV1 is the NAV at end of the year, NAV0 is NAV at the beginning of the year. You can see one thing in the question, the holding period is exactly 1 year. I1 is distribution on account of income and G1 is distribution on account of capital gains. So what we do now is, we have some missing information over here. Rate of return is given to you as 20%, correct? The annualized return is 20%. So we know the value of rate of return. NAV1 is the missing value and NAV0 is known. On the other side, this I1 and G1 is also unknown. So what we now do is, we don't know multiple values. So let us first do one thing, whatever values we know, we substitute that. So we have considered G1 as 0 because there was no information about capital gains as such. Now this I1 is still missing, correct? Because this could be the value of bonus, because there was no cash dividend, there was bonus. So we have considered I1 as the value of bonus, and this NAV0 was replaced with 25. So now you can see there are two missing values in the equation. When you solve this equation, so what would you get? 25 into 0.2 will be 5. 5 equals to NAV1 minus 25 plus I1. Now when you further simplify this, what will happen? This minus 25, if you shift this side, it will become plus 25. So 5 plus 25 will become 30, which will be the value of NAV1 plus I1. So I can write NAV1 plus I1 equals to 30. Friends, note down this whole thing before I take you any further or before I provide any further explanation. Alright friends, you would have finished writing this whole thing. Now, let us see what is the complication over here. We have this equation where there are two missing values, NAV1 and I1. Now, over here we believe that I1 represents nothing but the value of bonus units, but this has to be expressed in terms of per unit. Now, we don't know the date of bonus, and the question has emphasized that the bonus was received during the year. We don't know the exact date, we don't know the number of bonus units. Therefore, the only way we can work it out is to assume that this bonus was at the end of the year, and because the value of bonus was 20,000 against the original 10,000 units held, I would say against each unit held, the value of bonus unit will be rupees 2. And accordingly, if I1 is replaced for 2, you can get the value of NAV1 as 30 minus 2, that will be 28. So friends, that way you can solve this equation definitely. So what I'm going to do is I'm going to present that part of the solution also along with the explanation. Please carefully note it down. First thing, you write the fact that the equation above has two unknown variables. The date at which bonus units were issued is not given and NAV of such date is unknown. Therefore, assuming that bonus units were distributed at end of the year, the value of bonus for each unit originally held equals to rupees 2 per unit. Now focus on this line. Originally we had 10,000 units and the value of bonus in total was 20,000. That results into one fact that the value of bonus for each unit originally held will be rupees 2, and once we get rupees 2, I told you we can solve that equation easily. So before we go further, just understand one thing. We have replaced this rupees 2 for I1, and the moment you do that, you get the value of NAV1 as 28. So do one thing friends, write down this whole thing properly and then we move ahead. Alright friends, you would have finished writing this whole thing. Now let me show you one alternate way to solve this kind of question, particularly a question where some missing information exists. In other words, where some information is missing, you can handle the question little differently instead of writing that rate of return formula. And please pay attention on this whole thing what I am presenting over here. You can make this kind of table where the initial investment will be 10,000 units, and that day each unit was bought at NAV of that date, which was 25, correct? So 10,000 units into 25, rupees 2,50,000 is the investment at the beginning of the year. Now what happens? At this investment, the investor has earned a return of 20% overall, correct? So 20% is the rate of return during the year. So it is obvious that the value in hand by end of the year will be 3 lakh rupees. So total wealth in the hands of the investor at year end will be 3 lakh. Now obviously this 3 lakh includes bonus also, correct? Because this is the total wealth. From this 3 lakh, if you subtract the value of bonus units, value of bonus was given as 20,000. So if you subtract this, and we have assumed that this bonus was given at the end of the year, so this 3 lakh is at end of the year, 20,000 is also the value at end of the year. So obviously the balancing value will be the value of the original units. Original units value will be 2,80,000, and original number of units were 10,000 units. So now through this we can definitely find NAV per unit will be rupees 28. So friends, note down this also. In exam, there is no need to present both the versions of solution. You can present anything that you prefer. I would prefer this approach when the question has some missing information. So write it down quickly and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and write the last part of the solution. First thing what we would do is we will mention the total number of units received as bonus. So because of our assumption that bonus was distributed by year end and its value was 20,000 in total and 28 was the NAV as on that date. So by way of bonus, the company would have definitely distributed 714.2857 units as bonus. And now, if that 20,000 was not distributed as bonus but as cash dividend, anyway, 20,000 divided by 10,000 would give you rupees 2 per unit as dividend, and the moment you replace I1 for 2, the NAV1 value will still be 28. That means it does not make any difference in the hands of investor whether those benefits were given in the form of bonus or cash dividend, as far as that year is concerned, where the return overall was 20%. The NAV at the end of the year still remains 28. So note down this as well, and that will be end of the solution. Alright friends, you would have finished writing this whole thing. Let us move ahead and take up the next question, that is question number 4. Let us read this question. On 1/4/2010, Mr. A acquired 10,000 units in a mutual fund at NAV of rupees 40 per unit. On 1/7/2010, the mutual fund company declared bonus units of total value 4080, and the NAV on such date immediately after such bonus was rupees 40.8. The company distributed cash dividend of rupees 7,000 at the year end, and the annualized return for Mr. A was 30%. Determine the NAV at year end and the number of units distributed as bonus. Now friends, this is again a question where bonus units are involved, but little different question. This time the date on which the bonus was given is known, NAV on that date is also known, and the value of bonus units is also known. So we know multiple things. Now there is no scope of taking any assumption. In fact, this question does not have any missing information. It would be much easier way to solve this question. So let us see how to present the solution. In the solution, again you will go with that tabular presentation. Your initial investment was 1,000 units into 40, that was 40,000. Your overall returns for that year was 30%. So add returns and you get the total wealth in hands of Mr. A at year end. Now friends, what will happen? This is the total wealth. Total wealth includes three things: original number of units, bonus units, as well as dividend. First, what we do is we subtract the cash dividend. Cash dividend was 7,000 in total, correct? Rupees 7 per unit multiplied by 1,000 units, it was 7,000, and the wealth in the form of NAV will be 45,000. Now this NAV represents NAV of 1,100 units. Now how did we get this 1,100 units? I'll be explaining you in a while, but If 45,000 is the value of 1,100 units, you can definitely find the NAV per unit by dividing 45,000 by 1,100, and what you get is 40.91. Now let me explain you how we got this 1,100 units. So originally we had 1,000 units and bonus units which were distributed during the year. The value of those bonus units on that date was 4080 and 40.8 was NAV on that date. So it is obvious that the total number of bonus units will be 100 units, and finally the cumulative units by end of the year will be 1,100 units. So friends, the whole solution is presented right in front of you. Before I take you any further with other questions, please note down this whole thing carefully, and then only we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and take up the next question, that is question number 5. Let us read this question. On 1/4/2007, Mr. B acquired 10,000 units in a mutual fund at NAV of rupees 25 per unit. He decides to hold these units for 2 years and plans to reinvest all the dividend and growth distributions. As on 31/3/2008, his annualized return from the mutual fund was 24%, and at the year end, he has received the following cash distributions: 30,000 on account of growth and 30,000 on account of dividend. As on 31/3/2009, he further received the following cash distributions: rupees 48,000 towards growth and rupees 36,000 towards dividend. Further, the question is informing you that his annualized return for the year ended 31/3/2009 was 25%. You are required to determine the following: NAV on 31/3/2008 and 31/3/2009, additional units purchased on 31/3/2008, total realization from mutual fund as on 31/3/2009 if he sells all the units, and overall rate of return for 2 years. So friends, the question has asked you many things. Let us solve one by one each of these. So what we do is we begin with the amount initially invested as 2,50,000. That is, this investor has bought 10,000 units at rupees 25 per unit, and finally it was 2,50,000 as originally invested. The returns for the first year was 24%, which is 60,000. So 24% of 2,50,000 will be 60,000. Now this return added to the initial investment, the total wealth in hands of Mr. B at the year end will be 3,10,000. Now this 3,10,000 being total wealth, it includes the distribution of dividend also. So subtracting the amount received in cash in the form of dividend towards growth and dividend, basically it should be gain and dividend, but the question has mentioned the word growth, so in solution also we are writing the words growth. Finally, wealth in the form of NAV will be 2,50,000. Now NAV per unit you can easily obtain, because here there were no bonus units. The number of units held till now are just 10,000 units. So 2,50,000 when you divide by original 10,000 units, NAV at end of the year will be again rupees 25. But now whatever amount has been received by way of dividends, the investor decides to reinvest everything. So this 60,000 will be reinvested at this NAV. So additional units that will be purchased on that year end will be 60,000 divided by 25, and that will be 2,400 units. So friends, do one thing, write down this whole thing and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and take up the calculation for the next year. But you should understand one thing very well. Originally there were 10,000 units, and at end of first year additional units purchased were 2,400 units. So at the beginning of second year, now you will start with 12,400 units. That is 10,000 units originally held plus 2,400 units acquired at end of first year. So at beginning of second year, in total you have 12,400 units, and NAV is 25. As we have worked out, NAV at end of the first year is 25. So this is the initial investment, not from the viewpoint of overall investment period, but this is the initial investment for the second year. Returns for the second year were 25%. 25% added to 3,10,000, you get 77,500. Total wealth in the hands of Mr. B at the year end will be 387,500, and whatever amount you have received by way of growth and dividend distribution, that is the cash distribution, is 84,000. Finally, the wealth in the form of NAV will be 3,03,500, and now there are 12,400 units. So NAV per unit will be 3,03,500 divided by 12,400, and that will be 24.4758. Now, what is the total realization by end? That can be easily worked out. Understand one thing. This is the point where the investor has decided to encash everything and come out of this investment. Therefore, at this stage, there will be no reinvestment of this dividend, correct? So what you will do is, total realization will be, this 12,400 units will be sold at 24.4758, which will give you realization of 3,03,500, and plus this 84,000 is already realized in cash. So your total realization will be 387,500. Do one thing, write up this calculation, and then I take you ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and solve the last part of the question. The overall return for 2 years has been asked. So if you could understand one simple thing, originally the investor has invested 2,50,000 and final realization was 387,500. So 387,500 minus 2,50,000 divided by 2,50,000, the overall return for 2 years is 55%, and this being a block period of 2 years, the annualized return will be 12 divided by 24, or you may take 1 divided by 2 also, because it is 1 year divided by total holding period of 2 years, and average rate of return or annualized rate of return will be 27.5% per annum. So friends, do one thing, write up this whole thing, and that will be end of the solution.